Aloha Big Wave Trading family. I hope you're having a nice weekend. It's going to be a long video lesson. I like to arbitrarily cut these things off at 10 minutes just based on whatever I can get out of my mouth in that period of time. I want to make it clear that all of these long positions that everyone here is seeing, this is not normal, and this will probably not happen again in my lifetime. If it does happen again, it'll probably be 20 years from now. I didn't start trading stocks until 1996. I didn't become consistently profitable until 1999. And by then, I had enough of my beautiful charts working really well. The same kind of similar setups you see now, but they were better. And I could really push size into them confidently, ignorantly, because I was young. And I could hold small amounts of positions and make significant gains. After much testing, it's apparent to me that the right amount of stocks and position size is 10 stocks, 10% for most individual investors. I find that using this methodology, 10 stocks works well for the vast majority of people. 10 is very manageable on an end-of-day basis. But if you're watching these end-of-day stock trades intraday, whatever you do under your own volition, that's on you. That's not on the system. My trades are my trades, but my trades at the same time are not my trades. They are this system's trades. I have a large account capital base that I work off of and only pay $1 commissions. I live on Maui and have all of the time in the world from when the market closes 10 a.m. on Maui to when it opens at 3:30 a.m. on Maui. I have all freaking afternoon, evening, and night to do this stuff. So it's not a problem for me, but it could be on you. And my math has come out to show that 10 stocks, 10% is where to go. Now, me at this point in my career, I doubt I could ever put more than 5-10% in a position, but more realistically, 20 stocks, 5% of my account capital in each is the ideal holding period. And I will remind everybody, this amount of stocks is probably never going to be seen ever again. This is a byproduct of a market that refuses to sustain a 5% or greater downtrend, while at the same time continues to just barely melt up. We're starting to now turn a little bit more rapidly to the upside. The uptrend, the slope of the uptrend line, the regression line is starting to get a little bit steeper. So it's a little bit better. But that being said, the long positions all remain good enough to take, which means the reward risk ratio, if they do a previous measured move on the chart pattern, i.e. if we go long right here on the New York Stock Exchange, I cut my loss here, maybe on half or all, and then the rest here. But I'm expecting this move again, or any part of the move again, which puts the reward risk ratio at least 4-to-1, makes it a good enough trade to take. So keep all of this in mind with the new long signals. This is not normal. We are never going to probably ever see this many long signals with me holding this many ever again. I have not tracked this many stocks on an end-of-day basis since 2007. That was 10 years ago. In January of 2016, I was only tracking 28 stocks and long a total of 29 stocks at the 2016 lows. That's more normal. 100 positions, 50 to 100 positions, me tracking, not long, is very normal. This is not normal, and this will come to an end. Eventually, a market pullback will happen. We'll call the laggards. A few will hold up. I'll hold those. New leaders will show up, and we'll buy them. So with that in mind, I have a ton of new long signals, and they're all good enough, and I'll go over why. LPTH. You can see LPTH's entire previous uptrend, very strong. Strong accumulation, strong green bop. Look at the pullback. Low volume. Volume contracts, the average line. Now, as we start to move up the right side of this big saucer-like base, big saucer base after all the accumulation on this uptrend leg, we're now starting to see accumulation come back in. The pocket pivot point signals, these blue line surges return, and the green bob starting to slowly show back up. I want to get long here at 295. No chasing because it's extended from its 20-day moving average. I'm not going to go over the percent allocated either. You need to go check the new positions page for that. Just know that I can't put more than 0.5% of my account capital in any of these that I'm about ready to show you. So LPTH, this showed up in my low price perfect speculator scan, and it also was already in my Can Slim scan. So this is a Can Slim quality and perfect speculator stock. Now, why is it only $3? I don't know, and I never like that. But what I do like is that LPTH has already had a significant uptrend on huge accumulation and is consolidated on low volume. This means that this is probably a legit find, a diamond in the rough. So LPTH, I want to get long at 295. First cut loss level immediately, 282. And then move below 267, I'm completely out. So at worst, let's say all hell breaks loose on this stock, I risk about 12%. It's going to be about 6% because you got to half it. And even if I get a move from, let's say, here to here, that's a 36% move. It's not quite 4-to-1 even on that leg, but let's say I get a more true version of the move I'm looking for, to risk 6% to get a possible 90% move if we half it into 45. I'm looking at right around, a 6 to 7 to 1 or 8 to 1 ratio, risk reward ratio trade here. It's hard to pass up on these on my end when they set up because I don't care about taking losses. I tell you what, some of you guys freak out whenever you have to cut your losses short. I just don't. I don't care at all anymore. It's going to happen. It used to happen about 30% of the time before 2008. Now it used to happen around 40% of the time post 2008. And lately it's only happened about 15-20% of the time. That's abnormal. And even though it's happening 15-20% of the time, when these stocks fail, some of you guys freak out. Cut your losses, move on, and go to the next 5 to 10 signals that are triggering. That's all you got to do. You rotate it into new names and you put the capital to work. And if that cuts your losses, then you cut your losses again. And now you start reducing size. Your stock picker is broken. So now you start reducing size. Instead of putting $4,000 in the next trade, if I've been wrong on my last two, maybe it's $3,000, even though it's a $4,000 signal. If that one fails, even though I might get another $4,000 signal, now that I've lost 3-4 times in a row, now I'm only going to put $2,000 in. And I will continue to reduce size just like a good professional poker player does until I start winning again. Then I start compounding and adding and increasing my position size when my stock picker is working. So that's how this works. I don't care about cutting losses. You shouldn't either as long as you cut them. It's the only way to not go broke. I tell you what, the entire time General Electric's been downtrending, people have been asking me to buy this stock the entire year. And I've told them this thing doesn't look like it's bottomed at all yet. Well, finally, after Friday, I can seriously say it looks like it's finally bottomed now. If you want to buy GE, it's probably not going to go up right away, but now it looks like it's bottomed. And the whole point of this is that by not cutting their losses, how much did these guys lose before General Electric finally bottomed on Friday? I'm not into this game. Catching falling knives is the only methodology I will never bless. So LPTH, 295, 282, 267, those fail, I'm out. But LPTH, what we see here, bullish candle over candle, that hammer candle price bar, above average volume, increase in BOP, pocket pivot point signal. That's why that's a new long. Now SPPI just produced a 25% sell signal, but has now immediately given an add signal. Why? Because you got the bullish hammer reversal candle over candle price bar on well above average volume while keeping that max green BOP. So now that position that I just sold and took profits on, I'm ready to put back on. Now I didn't have an SPPI position. I'm being hypothetical, but theoretically if you had a position, you're now buying it back on. And with SPPI, this is a very nice chart pattern. If you're like, why are you buying a gap up like that? I'll remind you, I do this all the time. Here's OSUR and what it looked like when I went long OSUR back here. Same thing, gap up. It did nothing but uptrend the entire time. And VRTX is another one I can think of during that same period. Gap up right here, you buy, it uptrends the entire time. So that's what it should do. So if SPPI, I go long at 1937 and it fails this low right here, 1782, that's it. I'm out on the add signal. That's it. So I'm risking 4%. And if I can get this previous measure move just on the most recent uptrend, 79% potential gain to a 4% potential loss, take that trade any day. So SPPI, that's why this is a new long position. This one showed up in my low price perfect speculator scan, and it was confirmed in my price volume BOP surge scan and in my max green BOP for 5 days scan. OFIX is a former CanSlim quality stock, probably the only quote safe signal, but it's no longer CanSlim quality, but it still remains in that scan until I get a market-wide 20% correction. That's then whenever I purge the CanSlim scan and add all new CanSlim stocks into it. But because it used to be a CanSlim quality stock, OFIX showed up again on me, and plus I never got an initial position, was never able to buy it because of all the new long signals, so now I want to call on a position OFIX. So I'm going long OFIX. Let's see, it's supposed to be an ad signal, so it would only be 0.25% of my account capital in OFIX because it's also a little extended from the 20-day moving average 5 and 10 because none of these price lines are in that real body price bar. So that's why it's only going to be 0.25% of my account capital. But OFIX, candle over candle, hammer reversal price bar, no volume and BOP surge, but if you look at the RSI and MACD, there is a coil turn, but more importantly, right at the 5, 10, 20, and 50-day moving average, really reducing my risk if I'm wrong. Get long at 49.50, cut the loss at 48.50 right here, final cut loss below this green BOP bar, 47.26. If you don't know where to put your stops ever, if you don't have BOP on Telechart, just use the most recent support low. So instead of 47.26, 47.16 right here is the low. You use that level. Then there's CORI. CORI, this showed up in my perfect speculator low price scan, not confirmed anywhere else, but I want to get long because my risk is severely reduced. If I get long with the limit order at 1035, I got 994 right here to cut my first half loss, and then boom, 967 to know I'm wrong. I risk about, once again, looking at this reward risk ratio, I take these trades, 4.5%, and then ultimately, if everything goes right, hopefully I can get a 135% gain. What kind of reward risk ratio is that, guys? That's over 30 to 1. I'll take that any day. Even in the most recent leg, if I risk 5% on the trade to possibly get a 35% return, once again, 7 to 1 reward risk ratio. This is why I can't pass on these trades. I will hate myself if I don't take the trade and it makes that 35% move. I won't give a damn if I have to cut losses because I'll move it on to the next signal because there's always a next signal. I don't want there to be any more signals. I'm sick of this. I am over this. This is too many positions even for me, even though I can technically handle it. It's still too many and it's hurting my returns, but I'm in the middle of beta testing a lot of different methodologies, which means I need to continue to plug on until there's a bear market. Then I can go back and quantify what worked and what didn't work and then move on from there. UQM, same thing. This was in my low price perfect speculator scan. It was also my green bot for 20-day scan. We got that bullish hammer candle over candle pattern. No confirmation in volume, but that curl turn is there. But the most important thing there, the support. It's right there. I get long at 119. If it fails 110, I'm out. And then you can even use like, I don't know, what's this low here? You could even use this, 91 cents if you want to like give it really a lot of room to work. I don't recommend that. If it fails 110, just get the hell out. Maybe 110 and then the 50-day moving average. That's more appropriate. But UQM, once again, with this chart pattern, with that previous up leg, with all the accumulation, with the potential reward to risk ratio, it's impossible for me to pass on. I can't do it. CDNA is about the only stock I can legitimately say I probably shouldn't take this one. But I'm a sucker for nice charts. And this price pattern is very nice. It's not necessarily symmetrical yet and long enough, but it's symmetrical to this move. So maybe it won't take that long. It already looks like it's doing the bullish candle over candle near the high, actually high of day close. So candle over candle, reversal, hammer, full body, price bar with the high day close in a very tight flat base pattern. Even though BOP's going the wrong way, at least it's green. Volume's drying up, so I assume it's just ready to blast off again. But if not, the play is simple. Long at 585, it fails 531, you're out. And then you could even like use this gap fill at 475. I think that's 475. Yes, it is. So you could even use a second stop there. But for me, if it doesn't move higher immediately at 553, 585, I mean, I'm out at 531. It's just that simple. But CDNA, it's that tight price action. It looks like it wants to blast off higher. So I would rather lose here and take the small loss than risk seeing it do another one of this move. If I don't take CDNA and it makes a 275% move without me when I only had about 6-7% at risk, I'll hate myself. So I'm going to take CDNA. Then there's Snap. Snap from the IPO scan. By the way, CDNA showed up in my low price perfect speculator scan, which is why I consider it, quote, quote, higher quality. Used to be in my BOP scans, isn't anymore. It might show up again. Snap. This was in my Can Slim scan, but clearly it's not Can Slim. It's just extremely liquid, and I don't know why, but I throw it in there whenever it's a very liquid IPO, a new issue, and it's well talked about like Snapchat is. I consider it like Can Slim-like, but it's not. But Snap, IPO, so it was in my IPO scan. I know a lot of people follow it. We got a bullish hammer reversal, candle over candle price bar. My oscillators are curling. Once again, I get long at 15.56. My first cut loss, boom, right there, 15.18. Maybe your only cut loss. I can't take big positions, so I will also use this low right here at 14.47. 14.47 fails, I'll be completely out. But before 14.47 ever comes into play, I'll probably be completely out. It's going to have to crash on Monday for that to ever come into play. Need to start running through these, man. I really know how to blow VA. JNCE, candle over candle, hammer, reversal, price bar, above average volume. The indicators are coiling. Here's what good traders do. They get stopped out. A good signal presents itself. They buy it right back. JNC, following this candle price bar here, I was still long because my final stops are back here where the green BOP ends. It's where I still have some remaining shares left. Following this day, though, I moved half of my remaining shares up to just below 14.05. The next day it hit 14.01. Yes, indeed, my stops were hit. You never have to ask me. If I tell you that my stop is below 14.05 at 14.04 and you see a stock trade down to 14.01, you do not have to ask me if my stop hit. My stop hit all the time. I am not making these trades up. These are real life trades. I can't wait till I have enough members, maybe hopefully in the future, that I can make my chat room a screen share chat room and a voice over chat room so I can explain to you with my own voice and via the visual charting techniques of what I'm looking at instead of just posting it in the chat room. I'm far off from that. I don't have nearly enough people on this website. People seem to love gamblers way more than legitimate systematic methodologies. So since I'm not a gambler, I don't seem to be in favor, which is fine with me. It is what it is. I don't care. But the trading wise, JNCE going along here. Limit order 14.92, the high of the day. And your first cut loss, and maybe you only won 14.01. And then, of course, my final one, still back here, 13.10. It eclipses this 13.10 low. I'll be completely out. But JNCE, this is a beautiful hammer reversal candle. This thing should easily be able to go up and hit 20 if the market continues higher. So JNCE is a good long signal. CRBP, the same similar situation. This used to be Can Slim quality and BOP quality, used to be Can Slim quality, and it also used to be, wait, I'm in the wrong stock. I must be thinking of the different stock. Am I thinking of a different stock? I have to be. Okay, so let's forget all that. So, for some odd reason, I thought CRBP used to be a Can Slim quality stock, that Chinese name that I've been thinking of. I'm thinking of a different stock, though, I think, now that I think about it. But CRBP, look at this hammer reversal price bar following this powerful gap up on strong volume. Could have been a reversal bar, but the next day, very, very bullish hammer reversal price bar on above average volume, and BOP moved higher to max green. I love that. This one's simple. You get long at 780, the high of the day, and you have one cut loss right here at 735. And if you want to, you could even use the gap fill of the previous day gap up of 710. But I just recommend 735. With this reversal, with that volume and BOP surge, 735 should not fail. But that's a beautiful little reversal price bar pattern. And even though it's a low price stock, it's a pretty liquid name. It averages right around 400 to 500,000 shares a day. So I consider that a liquid stock. And with this price pattern, with that BOP surge and volume surge and move off the lows, and since we only have one cut loss level, that's why I considered CRBP quote, quote, quality and not speculative. If this was a $7 stock with a reversal like this, but this was a much more choppy chart pattern, and instead of averaging here 920,000 shares a day, it would be averaging 9,000 or 90,000 on this move up. Absolutely not. It's a speculative trade. But this thing is so liquid, and this is such a nice price candle bar with volume and BOP confirmation that I consider it quote, quote, quality. Okay, final one. I'm running out of time. EBR. Beautiful. Candle over candle. Reversal hammer. Full body. high a day, basically, price bar. Pocket pivot point surge on heavier volume with BOP surge, RSI, and MACD confirmation. This is a beautiful Zoom 4 chart. I love all the green BOP in this chart. I love this powerful gap up. I love how it eclipsed the low, then found support, and then rallied on stronger volume. Pulling back now, rallied again, and now pulling back on extremely quiet volume before really blasting off. But what I like most about it, at first I was like, this is more of a speculative position, but then it's a very liquid name. It's a Brazilian utility. It's a quality name overall because it's a utility stock, but more importantly, look at this long-term uptrend that is coming off those 2016 lows. Big previous uptrend has consolidated those gains and looks like it wants to rip higher. So that's why EBR, I consider it a quote-quote quality stock. All right, guys, this video lesson, way too damn long for my liking, but I believe it was 100% necessary considering the market condition and all the long signals to recognize why there's this many, why I consider these quality, even though none of them are seriously quality. The only true quality stock is a Can Slim and Perfect Speculator quality stock, over $20 a share. LPTH is the only Can Slim and Perfect Speculator quality stock by the true definition of Can Slim and Perfect Speculator, but it's not a real perfect speculator scan because I consider any price in one of my scans, and the true definition of a perfect speculator stock based on the book is a stock over $50. True definition of a Can Slim stock is a stock over $20. So to consider it a higher quality perfect speculator name, it needs to at least be over 20. If it's under 20, I consider it a low price perfect speculator name like SPPI, even though it's at 1937. It's not over 20. And to be honest with you, for the PS scans, I prefer a stock to be over 30. CAI is about as close as you can get. This was considered perfect speculator and Can Slim when I went long here at 25. Look at the previous uptrend. Look at the accumulation. Look at this chart pattern. It's also Can Slim. I consider this a higher price perfect speculator name, not LPTH. Even though it's high quality, it's only a $3 stock. Everything is relative, everyone. Everyone's a different kind of trader. I don't know what your personal risk tolerance is, what makes you feel comfortable. I don't know what stocks you like to get long. These new long positions, they're simply me telling you exactly what I'm taking, exactly what I'm doing. There's no smoke, there's no mirrors. I wish I could be that confident, ego-fueled trader that used to trade back in the 80s and 90s with the Can Slim methodology that's still 100% sure. That's how you do it. 4 stocks, 25% of your capital in each one, and they all rocket higher, and we'll do the post-analysis later on. Guys, that's all hindsight shit I see everywhere now. All these cocky guys that made the money in the 80s and 90s that are multimillionaires now, I clearly can tell that they are just selling their old methodology. A few might be making money, but in this market, if you think it's safe to put 25% of your capital in an individual name on anything other than an intraday time frame, my friend, you're crazy. I'm not crazy. I'm just a little hyper. All right, everyone, I got to wrap it up. This is ridiculous. Aloha.